and welcome to this our last Wealth and Investment Management Forum for the year, and what a year it's been. So today our topic is all around the substantial equity markets rebound in the last little bit, having a look at valuations and also importantly some commentary around our core Australian equities holdings. So plenty to talk about. Today we are joined by a number of team members, but the conversation will be led by Marcus Bogdan. Marcus, who you may have met in previous conversations that we've had, is our Aussie Equities Specialist, and he's also an investment committee member here at Prime. So Marcus is dialing in from Melbourne, and he'll be talking us through all of those key topics that I've referenced there. We also have online as well Mark Johnson, who is our chairman of our investment committee, a partner in our wealth management division. A lot of you would know Mark, but Mark will be joining for the Q&A session at the end of the presentation as well. So just a little bit of, I guess, admin side of things. If you would like to ask any questions, please do that through Zoom. We're going to have the Q&A at the end of Marcus's presentation. And also, one thing I did, I guess, want to highlight and do a big shout out and a thanks to our clients for this year. It has been one of the most amazing years with so many different things that have occurred for so many different people, and it would be completely remiss of me not to acknowledge and thank you as our clients for choosing to be with us. We hope that the advice and the service that we've provided during the course of this very unusual year you found valuable, and we very much look forward to continuing to serve and advise you into 2021. And on behalf of the whole of the Prime team, I really want to say thank you and best wishes for the festive season. If ever there was an opportunity to sit back and reflect on probably how lucky we are, I'm sure a lot of us will be doing that at the end of this calendar year. So thank you again for deciding to be our clients and our customers. We very much appreciate it. We're working hard to deliver on your expectations. And today will be, I guess, another opportunity for us to give you a feel for how we're constructing, recommending and advising as to how best to get the right outcomes for your portfolio. So the other, I guess, key item I want to highlight before I do hand over to Marcus Bogdan to present is our typical disclaimer. It is important. I don't want to dismiss this, but obviously anything we talk about here is general advice, and you should absolutely chat with your Prime financial advisor who will customize this to your particular needs. But you've heard enough from me, and I would now like to take the opportunity to hand over to Marcus, who is our specialist, our expert, our guru, the man with all of the answers. And I thought I'd just make it nice and simple for you there, Marcus. But we very much look forward to hearing from you, Marcus, about this amazing sort of 4, 5 and 6 weeks, which I guess just brings it to the conclusion of what's been a pretty amazing year. So over to you, Marcus, and I'll let you take over from here.
Well, thank you very much, Simon, for having me on. And really, the subject matter today is a remarkable year for global equity markets. The agenda today is to really look at and review what has happened in equity markets for this year, how it's affected earnings and dividends, and what the current ASX 200 valuation metrics are, both on a price earnings ratio basis and a dividend yield. And then we'll look at where we are in the profit cycle and the economic cycle as well. And then we'll step into the portfolio and where the portfolio is positioned and our recent tilt towards value and cyclicals. And then finally, we will look at and discuss some of the key stocks that we have in the portfolio. So we might start with slide 2 and just look at what's happened this year and why it has been so remarkable. So the ASX 200 peaked an all-time peak on February 20, and then we had this incredible event based retraction in the market, and it was driven by COVID. And within a month, we saw a contraction of the Australian market of around 36%, an unprecedented fall in such a sharp period of time. The markets troughed on the March 2023, and as you can see, it has steadily worked its way up to be only around 6 or 7% below its previous peak in February. So it has been a remarkable recovery, and we saw the significance of that in November, where the ASX 200 increased by around 10%, which was one of the strongest months on record. And there's been really three key drivers for the recovery that we've seen in global equity markets and particularly in the Australian market. The first element is really what we've seen from central banks and from governments. So the monetary and fiscal support has been at unprecedented level. And for the first time, it's really worked hand in glove in bringing a very coordinated approach. We've had an artificial stopping of the economies, but as a safety valve, we've seen, and a safety net, we've seen very rigorous fiscal support, and we've had support both in monetary policy in terms of lowering interest rates and also quantitative easing in Australia for the first time. The second element, which has really driven why the markets have been so strong, is that support has led to much better economic data, and that's fed through into a much better earnings outlook for Australian companies. In fact, we've gone from negative earnings revisions, which we were seeing pre-COVID, to a period of sort of an upgrade cycle in earnings. So we've had positive revisions. And the final part, which has come in more recently and really underpinned that drive that we saw in markets in November, is that we've had much better news on vaccines. We've seen multiple vaccines coming to market and also starting to be approved, and what we're seeing in the UK, starting to see that distribution there. So they're the sort of the underpinnings of where we've got to today and why we are so close to our previous peak. If we turn to the next slide. There is no doubt that the pandemic has had a great impact on both earnings and in dividends. For the financial year 2020, we had a 20% reduction in earnings per share and around a 25% reduction in dividends. So absolutely material, but to put that into sort of a historical context and maybe looking at it compared to the global financial crisis, where in that period, we had a contraction of around 30% in earnings, which we saw a decade ago, compared to around 20 this time. But what we're seeing in this recovery is a much sharper rebound. And if we turn to the next slide and we look at where we are in terms of valuations and dividend yields, the current 12-month forward price earnings ratio, PER, is around 19.5 times. That is high from an historical perspective. If we take a 30-year average, it's around 14.5 times. And that premium has been driven largely because interest rates are so low, and that is incredibly supportive of risk assets. But it's also reflecting the fact that earnings have been in a trough phase, and now we expect earnings to recover. And the expectations that earnings will start to catch up with the valuation. What is also incredibly important for investors is the dividends that they receive from their investments. And at the moment, the dividend yield for the Australian equity market is around 3.5%, which is well below the 30-year average of 4.3. But we believe that is a trough, and after seeing a contraction of dividends of around 25%, we can build out now where we start to see that recovery there. So if we turn to the next slide, and this is really putting where we think we are in the earnings cycle. Coming into COVID, we were at a very much a mature end of the economic cycle, and we could see that there was slowing of earnings growth. There were greater earnings revisions downwards than upwards, and in that period of time, we did tilt the portfolio to more quality companies. We have reset the bar now, and importantly, what we firmly believe is that we're in the earnings expansion period, and this is the longest period in the economic cycle where we've seen a trough in earnings, and now we're going to see earnings grow over a period of time, and that is definitely supportive for equity markets. If we turn to the next slide, and this is why we are constructive around the Australian equity market going forward. We've been through a period of earnings revisions of downward earnings, and now we're at the point in the cycle where we're starting to see a recovery. We're coming out of lockdown, industries and businesses reopening, and now for calendar 2020-21, we believe that we can see earnings per share growth of anywhere between 10 and 12%, and that growth will carry on to into the financial year of 2022, and we expect that earnings will fully recover from their previous peak of 2019 in the second half of FY 2022. If we turn to the next slide. And this is just an illustration of really what has happened in the last decade, and where there has been tremendous support for growth assets and for defensive assets compared to cyclical and value stocks. And this period of growth has been unprecedented from 2010, and you've seen a huge dispersion in returns. You've seen high price earnings companies like growth stocks at levels at unprecedented levels, supported by the fact that interest rates are so low, and that we've had significant changes in the economy, and the gap between high price earnings ratio companies, which are around 35 times on average, compared to low price earnings ratio companies, which are around 12 times, has never been wider. But as we're seeing a cyclical recovery occurring in economies, and we're at the early stages of that, there has been a refocusing back to value and back to cyclicals, and we're at just at the foothills of that, and that is one of the reasons why we've started to see better value in the share market in this value and cyclical space. And if we turn to the next slide, we'll start to talk about the individual companies that we've got in the portfolio and how our portfolio is currently structured. And it's important to note that we are always run a well-diversified portfolio of leaders of the ASX 200. And we've broken this into really two parts. The first part is companies that have shown incredible earnings resilience through the COVID period, and companies that we believe will actually come out of COVID in a stronger position, both at a company and an industry level. And those companies are Brambles, Cleanaway and Woolworths. But we've also got a firm eye on what we're seeing in this rotation back to value and back to cyclical companies. And we want to buy leaders in that particular area. And so that earnings recovery companies are things like BHP, Ramsay Healthcare, and Westpac. And I might just spend a couple of minutes talking a little bit about the investment thesis around each of those companies. And I'll start with Brambles. And Brambles is a global leader. It's a company that was established in Australia in the 1950s, and its primary business is the wooden pallet, which you would often see in society, which is really underpins the transportation of goods. Their largest markets are in the United States and in Europe, and they're the market leader in that industry. They are very much focused on consumer staples. 80% of their business is related to moving consumer staple goods around those economies, and they have recently upgraded their earnings forecasts to 3 to 5% earnings growth for 2021. Strong balance sheet. Very strong position in their industry, and they really play a pivotal role in the first mile and the last mile of supply chains. Cleanaway Waste Management is Australia's largest waste company in Australia. It is underpinned by long contracts primarily with councils for the collection of waste, but they also recycle that, they store that, and that company has generated significant earnings growth and dividend growth in the last several years, and we feel that they are very well placed to participate in both the old and the new economy in terms of the infrastructure that they've got in renewables and a circular economy. And again, a very strong profile in terms of earnings and a very strong balance sheet. Woolworths, we firmly believe, has strengthened their franchise through COVID, primarily through people working at home, the need for consumer staples, but also, they have delivered like-for-like sales growth in the last report of around 11%. They've had a 100% uplift in online, and that's an important area of growth for the supermarkets, which they are dominating. And they are seeing parts of the business recover in Endeavour Drinks, which is the Dan Murphy and BWS franchise, and in their hotel business. That will be spun out in the next year, and so we're expecting further capital returns from Woolworths going forward. So they're the companies that have shown real earnings resilience through this period, but also have a very sound outlook going forward. The second part of the portfolio, and where we've tilted to, has been in these earnings recovery companies. And the first one has been BHP. And yes, their linkage into the iron ore market and the steel markets in China is absolutely profound. And China was the first country that went into COVID, but they were certainly the first country to come out of it. And we're seeing a very strong rebound in economic activity in China, and that's been primarily driven through steel production and the support of infrastructure in construction and the property markets there. And iron ore, and whilst there is a significant dispute occurring between Australia and China, iron ore sits out of that bubble as a key input in their economic recovery. And Australian export receipts, despite all of the ruptions that we're seeing with this current dispute, our export receipts are actually higher than they were a year ago. And that's primarily been driven by the strong price and volume growth that we're seeing in the iron ore market and the impact of what we're seeing on supply constraints from the other major iron ore market in Brazil. So BHP are generating lots of free cash flow, very strong balance sheet, and the expectation of very attractive dividends going forward has led us to be as one of the biggest positions in the portfolio today. Ramsay Health Care is Australia's largest private hospital operator and is also a significant player in both the UK and Europe as well. And their business has been dramatically impacted by COVID and the cancellation of elective surgery. But what we're seeing today is a very sharp recovery in surgical routines, where there's been a growth rate of at least 8% compared to a long-term average of 4%. And so we're seeing the backlog being addressed in Australia, and the demand for private health services at an unprecedented level. And one of the drivers of that is that the public system is at absolute capacity in terms of the constraints there. They are now entering into partnerships with Ramsay to contract surgical volumes there. So we expect that this growth pattern in Australia particularly will have 12 to 18 months to play out. And what we're also seeing in the UK and France and in Scandinavia, which is the other area that they're operating in, is that the governments are entering into a long-term contractual arrangements with the private operators to help the backlog that they're seeing in surgical volumes there. So a global leader in an essential industry, and we believe that we'll see good earnings and dividend recovery in Ramsay. And the final company that I'd like to touch on today is that we have built up our position in the banking sector, and that's primarily been led by our investment in Commonwealth Bank and now in Westpac. So Commonwealth Bank is the premier bank in Australia. It trades at a premium, but it has had the strongest earnings and dividend outlook of any of the banks. And Westpac trades at the biggest discount to the retail banks. And we do see, after a very difficult period for the banking industry, signs of recovery. There's regulatory change, there's a push to housing, we're seeing recovery in credit growth, particularly around mortgages. We're seeing regulatory relief. The capital position in the banks is now unquestionably strong, so they don't need to come back to market for greater issuance. And so we do believe for the banking sector that earnings have now essentially troughed. Dividends have been cut back dramatically, but now they are at a far more sustainable level in terms of payout ratios. And we do see that the dividend yields for the banking sector returning back to to the vicinity of 4.5% to 5% fully franked over the next 18 months or so, and that's why we've built up our position in the banking sector over the last several months. So that's a snapshot where we are. Markets have run particularly hard, and I wouldn't be surprised to see some sort of consolidation in markets for a period of time. But we're very constructive about the earnings outlook and what the underpinnings of that for 2021 and our confidence around holding these industry leaders in the Australian equity portfolio. So I may stop there, and I'll hand it back to Simon to see if there's any questions that you may have in relation to the Australian equity market.
Thanks a lot, Marcus, and I will also actually welcome back into the this part of the session Mark Johnson and also Cam, who's joined us as well. And Cam, as most of you would know, is an investment committee member and also a partner in our wealth division. Look, there's not a question there at the moment, so I encourage anyone who would like to ask a question, please just pop that online. But probably not surprisingly, Marcus, I have a couple of questions. So I'll try to make them the easy ones, but just I find it interesting the depth of the research that you do, and a lot of that is through conversations with CEOs and leaders in these businesses that we're investing in on behalf of our clients. And I think, and I'll get this wrong, but I think in the last 6 months you've had almost 200 calls with leaders of these businesses that we invest in. And I just probably want to ask is, do you get a feel for their confidence levels now, or particularly in the last probably say month or two, versus what you might have heard from them say 6 months ago or 9 months ago when we were at that kind of that start of the impact of COVID? And kind of the second part to that question is just, do you hear from them, sort of any anecdotes about lessons learned, or where there might have been some frailties in their business and how they might be addressing it? Or do you see any sort of themes prevailing by virtue of those conversations? And I know that's quite a big question, probably not an easy one to answer, but I'd imagine with so many conversations taking place, you do start to get a bit of a feel for where people are at, especially if you've been speaking to them over the course of say 1, 2, 3, 4, 5 years. But I might just table that and just get a bit of a feel for what you're hearing.
Yeah, no, it's a really important question, and the conversations have absolutely changed, because at the beginning of the pandemic and what happened and the lockdowns that occurred, I mean, no business had gone through that, and so there were there's significant catch-ups on protective equipment of how you were going to manage things, and there was incredible stresses in supply chains, and that took a while to work through. There were delays in goods coming through, particularly imported goods, and then there were particular industries that actually virtually came to a standstill, and so each of that was different for different companies, but that was very much a common theme. And then very quickly, though, you saw companies sort of right size, get all of the equipment, all of the processes in place. And when we've had this second lockdown, the evidence has been shown of how, for example, Brambles, which they were impacted by the shutting down of the automotive industry globally. But even in the second lockdown in COVID, the automotive industry has been able to stay open because they've got things now in place. Supermarkets are much better in terms of managing their inventories, understanding the supply chains, and those supply chains have essentially opened. And then, with a lot of businesses had a surge in sales, but they also had a surge in in costs as well, and then managing those costs through that period of time. And as we come out of that, hospitals is a great example of that, where you had a rise in PPE costs. So a surgical mask on average was 3 cents before COVID. It went up to 23 cents at the peak, and it's around 15 cents today. And then you've had, people standing there taking temperature. All of those costs are going to start to come back, but then you've still got the operating leverage there of higher volumes. So significant changes in supply chains, and many companies just thinking about the diversity of their supply chains, of bringing things closer to their localized market as well. And then we've had sovereign security issues that we've had to deal with. So Ampol, for example, is bringing in fuels into Australia, whether it be for cars, for diesel, or for jet fuel. Now the government is thinking about, well, we need greater storage facilities so that we've got not just 30 days of storage for Australia, but we're closer to sort of 60 to 90. So if there's ever a disruption there, we've got those facilities in place. And so those conversations have absolutely changed through that period of time. And it's also allowed us to either be more confident or less confident on particular companies that we've had in the portfolio. And that's, it is a highlight of why these conversations are so important, and why this iterative process is essential in our understanding of companies as well.
Yeah, and it's interesting. One of the other questions and that's very helpful, and because I think it's often kind of the lessons learned through this process, that you tend to be able to start to pick the future winners based on how they've been able to, deal with the challenges that have been presented, and the culture that sits behind the company in order to facilitate that next leg up. And you did touch on it in your presentation, and the fight that's taking place, if you like, between Australia and China at the moment, and the fact that that's probably not impacting on the BHPs or the Fortescues of this world as much as it might impact on others. But do you, when you sit back and you think about this in terms of a portfolio, and you mentioned sovereign risk and various other things, do you think that we're at the start of this in terms of whether it's lamb exports or whatever it might be? Do you feel like this will just continue to gather pace, and that this will have long-term considerations for any of the companies in the portfolio? Does that start to come a bit more forward in your mind in terms of, okay, who's most exposed to this? What's the next thing that might very well be impacted? And again, not an easy question, but just be good to get between your ears on this one.
Yeah, and we've had some important dialogues, and one earlier this week, which I'll share some of the highlights of that. But primarily, where our exposure to that market has been limited to the iron ore market. And one of the things that I was told very early on in the dispute from a trade representative was that if you are positioned in these markets, you want to be positioned in a product where they've got very little choice, because what China is definitely wanting to do is to diversify their supply base, which is absolutely rational, and every country doesn't want to be just dependent on one source. And so our export receipts to China are about $150 billion a year, of which probably 50 billion have been under duress or under threat. And Australia is definitely a diplomatic test case of how far they can push certain jurisdictions. Australia is a very good example of that. And I don't think, from what we're seeing at the moment, is that this is going to be repaired in the short term. And so I'm still very mindful of those areas where, on agriculture, on grain, on wine, on thermal coal, where there are plenty of choices around the world and substitutions there. I think that is still at risk, and an area that we really want to stay away from. And it has broader implications. Obviously, our tourism, our education is very much dependent on just one sleeve there, and we do have to pivot ourselves and expand that over time. But from a portfolio sense, we haven't been exposed to that area, and I'm certainly not rushing back on that. On iron ore, the conversations we had earlier this week is that, at the moment, and what we can see, it does sit outside of this diplomatic frac oil that we're seeing at the moment, because it is such an important component of which underpins their economic activity as well. And again, it highlights the diversity that we need to have in the portfolio as well.
And look, I think that's super helpful, and just the fact that we know that we're not just sitting back looking at a set of numbers to make investment decisions, on what's being reported by companies, but in fact, sort of, lifting up the hood and having these sorts of conversations, I just think are extraordinarily important. And just one other thing which I thought probably worthwhile mentioning, which we sort of came through in the last 24 hours, and it's not a company that we're talking about at the moment now in terms of those 6 that we've been speaking to our direct clients about. But it was interesting to see that Helios, which operates in a similar space as Ramsay, from what I understand, they've flagged a capital return to their shareholders, a couple of $100 million capital return. And I just think that's interesting in this environment and I'm not sure if that came off the back of a transaction or how that came about, but I just felt that's interesting that, in this environment, you've got companies willing to return capital to shareholders. I think that's probably an interesting mark of confidence that they must have in terms of their future direction. Is there anything you'd like to make? I know this is a portfolio company in terms of our separately managed account, but is it worthwhile just touching on that briefly and just sort of, your view on that? Yeah,
absolutely. So Helios very much sits in the value bucket, and it has historically been an underperformer, even though it's had a very significant positioning in medical centres, in pathology, and in diagnostics. And the rationale for the capital return was they sold their medical businesses, which have been a problematic business for them for a number of years. They got around $487 million for that. They received that payment last week, and that's prompted the $200 million buyback. But it's also done a couple of other really important things. It's effectively de-geared the balance sheet. So it was nearly trading at a net debt to EBITDA of 3 times. It's under 1 now. So we don't have that financial risk there anymore. But more importantly, the Investor Day, which they hosted yesterday, also showed, importantly, improvements in their underlying business and confidence around pathology, which has done particularly well in COVID in terms of COVID testing. Other pathology tests have come back, but they're seeing both COVID testing being strong and also people coming back for underlying health checks also coming back. And they're the second largest pathology company in Australia. But they've also been able to map out a 3% increase in their margin over the forecast period. And so that valuation still looks attractive, and we can see growth. And also, and another area of growth for them is in day hospitals, and we're seeing a very strong trend in day procedures as well. So net, it was a very pleasing day yesterday, because we've had to be patient with this company. We've had it in the portfolio for a couple of years now, and we're just starting to see the fruits of our labour there in that company.
Well, a very nice little Christmas gift. So just we've had a question come through here from Graham Stanley. And thanks, Graham, for the question. But any comments on what is going on with the price of gold? The market's going up, and so is gold. And is that historically consistent? And great question. Marcus, do you want to make a comment on that, or Cam or Mark? We might let you make a comment on that afterwards, once Marcus you've.
Yeah, sure. So we do have gold exposure through one company, which is Northern Star, and we like that company because where the gold assets are, we're not facing sort of jurisdictional risk in emerging markets. We like the owner management structure of the company. It's got a very strong net cash balance sheet, and it's also a diversifier in the portfolio. And so gold in this recent rally, in terms of the gold price and gold companies, have underperformed. So it's actually doing what we're expecting to do when there's a risk on process in the market that we're seeing today. Gold tends to be a sort of a counterweight in that, and then as things become difficult or there is a crisis there, it tends to outperform in that period of time. So we like the underlying company, the fundamentals of the company, and we do think gold, for a small part of the portfolio, is an important diversifier. But if Cam or Mark, if you've got any other comments that you'd like to share on that.
Yeah, I think we, for our client portfolios, we do have a small gold position for a lot of our clients in the alternatives bucket, and that is predicated off an expectation that the central banks around the world are going to keep printing money. So the printing money essentially does debase the value of the existing money in the system, and it does make reliable stores of value, which gold is one, a little bit more attractive over time. So central banks are on record suggesting they're going to do whatever it takes to keep stimulating the economy for at least the next year or two, we'd expect, and that should provide a tailwind behind gold, which, as well as Marcus's point that the second attraction is that gold doesn't always, but it quite often does appreciate in price in times of market dislocation and high volatility. So a hedge for the portfolio, but a hedge that isn't paying an income, but does have a tailwind behind it that would expect prices to continue to appreciate, albeit a little bit, over the next couple of years.
Yeah, thanks, Cam. And Mark Ruby's also jumped in with a question, which is great. So thanks, Mark, for that. What are your views on infrastructure assets such as CBD property? Now given the work from home experience, some of our clients would have exposure through various property trusts and that side of things. Do you have a view? And I guess equally, I think for all of our participants on this, from an investment committee point of view, we'll have a view. But maybe we could start with you, Marcus, and then work our way around. Mark, you can comment, and then Cam thereafter.
And so in terms of our property exposure, we don't have direct exposure to office markets or shopping centres. We do have it through logistics and warehousing through Goodman, because we just think that the industry dynamics there and being in a market leader is incredibly attractive over the next 5 to 10 years. And we do hold Waypoint, which is the sort of Shell Express petrol stations and convenience stores, but they are very long dated lease arrangements there of over 11 years with 3% escalators there. So that's our exposure there. At a high level, it's been interesting when we've been talking to corporates and what they're thinking about office space and going forward. and particularly chief financial officers are almost salivating at the potential of reducing their footprint and their cost, and they can see it as an easy win for them. And you know, we had the head of logistics for Australia Post on the other day, and he was saying, you know, we've got 20 floors there in Exhibition Street there. You know, these are great examples of where we can save money going forward as we sort of more permanently move to a sort of more hybrid model. And there was another corporate again who without prompting just called that out. You know, it was Medibank Private that was looking at their footprint and ways that they could reduce that. So I think there is a trend there, and I think, you know, we are changing the way that we work, and maybe a hybrid model is more appropriate. But we're not there. You know, yes, we can see the discount, but we can also see the uncertainty, and we can also see the fact that there are very large corporates that are really focused on reducing their overall property footprint.
Yeah, thanks, Marcus. Mark, do you have a view?
Yeah, I think it's important when we're looking at that property sector that we sort of we are mindful of, you know, the retail element, office, and the industrial side of things. And so the question was more around you know, the CBD and office space, and again talking to you know, different people around town. There's certainly a trend. You know, I guess there's two issues. One, there's a trend where, particularly in Victoria, we've had a taste of 9 months working from home, and people have worked out that you know, that things still get done, and business continues to work well. And then, you know, talking to a partner at an accounting firm, a large auditing business. You know, the fact that, you know, they've had 30 or 40 graduates come into their business and they haven't met them yet. And this whole issue of culture is something that I think that larger companies are particularly careful how they navigate that. So that I think there'll be some innovative ways that people will get their team together and keep that sense of culture and identity with the business. But like undoubtedly, that office space is going to be under pressure for the immediate and foreseeable future.
Yeah, and look, I'm not sure if you've got a view, Cam, but I can definitely speak from you know, as a leader in our business and conversations that we have, and take a practical lens there. I think you would want to be very careful about long-term decisions that you make off what has been a short-term experiment. And you know, it's been a period of 9 months. We've got offices in Melbourne, Sydney, and Brisbane. Our Brisbane office, everyone's back on site and has been for a few months, and you know, they're back to business as usual. And Sydney is probably halfway there, and Melbourne is obviously still working from home. And you know, Mark, you touched on it before then, and you know, culture is king. If you're wanting to make sure that you have got a connected team that are well supported to deliver advice and service or product, whatever it might be, to clients, you just want to be very careful about going for what might be a short-term win in terms of a cost base, but losing that connection, that opportunity to collaborate, to grow, to develop, and build opportunity. And that mentoring piece that you mentioned there, Mark, I think is very interesting. You know, we've obviously found ways of mentoring younger team members from remote locations, but you know, there's definitely advantages from being face to face. And you know, and I had the opportunity to catch up with you, Marcus, and during the week and have a breakfast, which was nice. You know, the first time we've had a chance to do that. So I think once people start to get back into that environment, you know, it'll be very interesting to see how quickly it can actually bounce back. So I understand the CFOs would be very excited about the prospect of saving money, but be careful what the consequences might be down the track. So I think a sort of a sit back and wait approach a little bit more. Yeah. Look, you know, and I think you know, this has been a really constructive conversation. I'm very conscious of everyone's time at this time of the year, and we are at 11:50, and we promised everyone a 50-minute session. And And I think it's been a really great conversation. And again, I just really want to thank you, Marcus, for joining the team. Your contribution, your knowledge of stocks, your past performance is invaluable, and it's helping us have better conversations internally. And I know that Mark and Cam appreciate that as well, as does the rest of the investment team. So thank you, Marcus, for joining us. Very worthwhile, and today has been no different. We've really enjoyed that part of our conversation. Mark and Cam, a big shout out and a thank you to you. I think it probably doesn't get said enough, but there is a lot of pressure on us and investment committees to make the right decisions when you have massive disruption like what has occurred in the last 12 months. So your steady hands during this period and performing well for our clients has been essential. So thanks for your efforts during the course of 2020, and we seriously hope that 2021 we don't have a repeat of what we've had to deal with. But thanks for working so hard for our clients as well. I'm going to end here. I'm going to thank all attendees for being part of today's session. We look forward to joining you again in the new calendar year. Please have a super fun and safe break, whatever you might be doing. And we really look forward to reconnecting in the new calendar year. And thank you again for being our clients. And thank you everyone else for joining us.